Uh, Good evening, everyone. Welcome to our webinar for tonight, where we will review the trading fundamentals like the break of structure, change of character, fair value gaps, and liquidity. So, is my audio fine? Can you hear me? Okay, thank you for confirming, Coach Jade. Now, before we begin, I will just play uh, some motivational video, just a short ones, just to motivate our mood. Okay, okay, that's about it. So, welcome once again to our webinar where we will have the overview of the trading fundamentals. Now, tonight we're gonna discuss about market structure, the basic market structure, types of break of structures, change of character, fair value gaps, and liquidity concepts in trading. Okay, these are very important. If you will be a trader, you will always hear these things here: market structure, breakup structure, change of character, fair value gaps, and liquidity. And we will have like uh, you know to get more of these things here, we have to dig deeper, okay, and know more about these things. Because if you want to be trading, okay, as your full-time job and earning money, you have to learn all this. When I started my trading journey, the moment I open my eyes in the morning while I'm still in bed, I will always uh, look for my mobile phone and open trading view. This is the very first thing I do every day for many years. Opening trading view, reading the gold chart, if we're going bullish or bearish on that day. I mean, I really love trading. Like, I breathe, I eat and live trading. Ah, I can never think of anything else on a daily basis without reading the chart. So every bit of even now, I'm still learning some stuff which I don't know. Some days there will be times I will learn something. It's a never-ending process. I hope you will do the same, or you have this passion in trading. You have to love it. Like, I will cry blood just to know something new. You cannot just be like, I can read the charts now. I know this thing will go up today or down today. No, trading is really serious. This will break your patience, your way of life. It will drag you down even to the abyss. You know, I hope you know what I mean. Uh, yes, you can see the lifestyle of traders having this fabulous cars and mansions, but in real life, a real trader is just he's a silent type. Like you don't know that this guy is trading full time. I know there are lots of fake gurus out there in YouTube, flaunting their millions or of dollars, but it so happened that these are just phonies. They don't know, or maybe they know something, but to be a trader, the silent type is the most dangerous type of trader. So anyway, we will not go into that. I'm just giving some overview of what a trader's lifestyle is, And for me, it's a never-ending process. You have to love this thing. You cannot just, feel proud and uh, like you know everything in the trading world. So you have to be passionate and love everything about trading. So we will go now to the next slide. Now we will have another real trading account, $1,000 giveaway for tonight, and hopefully we can uh, we can have a new lucky winner and benefit from this giveaway from our sponsors, Algoter. All right, moving on. Market structure. What is market structure? In trading, market structure refers to the framework of how price moves, essentially mapping out the patterns of higher highs and higher lows, uh, uptrends, as for uptrends, while lower highs and lower lows for downtrends. There's also some sideways movement. I hope you know what a sideways movement is. It's ranging or consolidating. It's a visual representation of price action that helps traders identify trends, support, and resistance levels, and potential reversal points. So, in a bullish market, you should always see higher highs and higher lows. Okay, it's that simple. If you don't see such thing, yeah, it's it's going nowhere. Okay, so you need to see higher highs and higher lows. In a bearish market, you need to see lower highs and lower lows. Simple as that. It's the total opposite. And break of structure. We will discuss more on this and a change of character. These are trading is all about. Okay, if you don't know how to read the chart well, you will just burning your money away for sure. Okay, moving on. Higher highs, higher lows, lower highs, lower lows. Okay. A higher high refers to a peak in price that is greater than the previous high. Okay. So that's why it's called higher high. There's something higher than the current high or the previous high. Sometime in the future, in a couple of minutes, in a couple of hours, depending on the time frame, there will be another higher high than the high you are looking at now. Okay. While a lower low is a trough. Okay. I know this word. I was confused. What's a trough? A trough is the previous price action. Okay, if you sell from such a price and it went down, then that will be the new trough. Trough. Okay, you pronounce it like that. That is higher than the preceding low. The presence of higher highs and higher lows in a price chart indicates that buyers are dominating the market and are willing to pay higher prices for the asset. That's why prices go up, because they are willing to pay higher prices than the current high. That's the only uh, explanation regarding that. Now, a lower low is a trough that is lower than the previous low. So prices are getting cheaper. It's going down. While a lower high is a peak that is lower than the preceding high. That's the meaning of it. The presence of lower lows and lower highs in the price chart indicates that sellers are dominating the market and are able to push prices lower. So in summary, higher highs and higher lows are the defining characteristics of an uptrend, while lower lows and lower highs and lower lows signify a downtrend. So it looks like this. This is the price action. So in an uptrend, there's a higher high, okay, and higher low. Price retraces not fully on the previous low, okay. It retraces at least 50% of this leg, and it creates a new higher high. So that's the higher high, higher lows, and higher lows. So this higher high is now higher than the high. That's why it's called a higher high. Higher lows, okay, this is higher. This is now higher than the previous low. So it's a higher low. That's in a, that's it. That's in an uptrend. And there will always be some sideways trends. They are having the same highs and the same lows. So this is in the sideways market now. Okay, now going to the bearish market, we produce lower lows, lower highs, another lower low, and another lower high. And these are now the troughs we are talking about here. So this is now higher than this previous high, and this is lower than the previous low. That's the price action in any chart. So looking at the chart now. Okay, this is I'm using the Fibonacci here. Go to the normal candles. That's it. This is in a sideways market. Okay, prices are just consolidating in this zone until it create a new lower low, and then another lower high, another lower low, like this. Okay, price went there, lower high, lower low, lower high, lower low. Okay, that's it. This low is lower than the previous low, and this low is lower than this previous low. So this is how you know you are in a downtrend. In an uptrend, simply like this. Higher high, higher low, higher high, higher low, higher high, higher low, until it broke this low. Now this is now going in an up. Now it went in the sideways until it went in a bearish market. That's it, my friends. That's how you will know these things. Okay? You see? You see their difference? Going up, breaking this higher low. Now it went to the opposite direction. Okay. I hope it's clear now. Okay. As you can see here, these higher lows are never broken by any price. Okay, this week didn't even reach this. So this is protecting this. This is another lower low, higher low, and another higher low was created here until it broke. Until this candle broke this higher low. Now, never think of buying in this time, because it will go down now. And in this example, it went in a sideways market. No, you will be trapped here. Okay? Because, okay, it's, for example, this is the first leg. Okay, it went up, it went down, and then it broke the higher low. Now it's a higher high. Okay? But you are expecting now for a retracement because this one should broke in the high high. Okay? But it never went there. Okay, it never break this high. Now you are going sideways. You are now going sideways with this. Okay, see, this is in equal lows. Okay, it should broke. It should broke here. It should go there, but it didn't. Now you are trapped in a sideways market. So you must always make sure that a lower low will happen in the future. Then you are in a downtrend. But in this example, it didn't. So you are in a sideways market. So until this broke here, and from this time, okay, hitting all this price action, okay, these are just like liquidities. Okay, it never really went to have a bearish market until this time. When this lower, higher low was broken, now this is now in a bearish market. That's it. Now you can confirm you are in a bearish market and then producing a new lower low and then a higher low and another lower low. So that's how you will know you are now reading the chart like a pro now. Okay, moving on. Break of structure. Okay, yeah, I think you've heard this now by now. Okay, what is a break of structure? A break of structure or BOSS occurs when the price of an asset moves beyond a previous level of support or resistance, signaling a potential shift in market direction. Unlike minor fluctuations, a true break of structure indicates a meaningful shift in the asset's underlying trend, suggesting that the market is moving from one trend to another. So, break of structure. Break of structure. Simply like this. It's simply like this. There's a new higher high. Okay. Now, what you noticed? What you noticed from this? A candle broke these highs. It went bypass this. This is now the boss, the break of structure. That is a break of structure there. Okay. Now, price really now flying at this time, but it have to retrace somewhere here. Okay. And then it created now a new higher high here. This is the higher high. Okay. And until it's got broken again by this candle, this is another break of structure. That's it. That's how simple it is. Okay. And it goes on in here. Okay. This higher high is now broken. Another boss. Another break of structure. Then until it reaches this point. Okay. That's it. That's how you know you are in an uptrend. Every higher highs are getting broken. Okay. See these candles here, this candle here, until it reaches this point. There. That's the highest price has reached at that time. That's how it is. That's how a breakup structure is. Now, Types of breakup structure. There's a bullish breakup structure. A bullish breakup structure happens when the price of an asset breaks through a previously established resistance levels, okay? Suggesting an upward trend. Okay, this is a resistance. This is a resistance. You know, whenever a breakup, a higher high is formed, it acts as a resistance. As we will go along on some other webinars, you will know why this is called a resistance. Okay, but for now, it's simply a resistance. Okay, you see, when it created this first high here, this red candle, a green candle tried to go up there, but there's a resistance. Okay, price never went through, and even this candle here tried to break through this, but it didn't. And then it went down, down, down. That's why it's acting a resistance. Same with this. Same with this. Until such time, it will break something. So the selling, buying pressure is more powerful than the sellers. So it broke this resistance at that time, creating more higher highs. Okay, and the process repeats just like so. Okay. This indicates that buyers have taken control, potentially setting the stage for continued price increases. By confirming the breakout above resistance, traders can enter positions aligned with a stronger trend in the market. So, when you see a higher high here, and it was retraced, okay, now you have your line marked like that. You just wait. When this candle closes here, okay, it closes here. Okay, some candles will be like this. Okay, so expect you can buy from here, from this, because it already broke this the break. It had a breakup structure, so prices wants to make another higher high, which it did. Okay, it retraces a bit. Okay, now remember, remember the fib retracement on our first webinar. Use this. Use the fib retracement. This is in a 5-minute time frame. Okay, up to the breakups, the higher high there. Where did I told you that golden zone? Where is that golden zone? It's there. 0.5 to 0.618. This buyers are waiting there. That's it. When price retraces to this golden zone, expect it to break this structure anytime soon. Now it went there. That's it. That's the fib retracement. Always go for the golden zone, my friends. It's that easy. I don't know how you are not seeing this. Now, last webinar, we talked about indicators. Now you have the MACD here. Okay, where is it going? It made the crossover. Okay, you are now in this golden zone, and MACD wants to go up, giving you even this green histogram. Now just buy. It will fly to the moon. Just imagine. Okay, you are here at this price, 333352. You are there. Just buy. You have a confluence of the golden zone. You have the confluence of the MACD indicator, histogram. Okay, maybe a fractal. Let's try the fractal now. Fractal. Remember the fractal? There, fractal. Okay, fractal. Okay, for the fractal, I changes to 8. Periods 8. It will be less noisy, less fractal, but solid. You see, there's a fractal. It wants to go up. Now you have 3 confluences, the fractal, the MACD, and your golden zone from the fib retracement. Price went there, time to buy. Buy, buy, buy. Now it's going to break this. That's it. I hope you have a clear picture now. Why people are sometimes so smart that they can just this will take experience, months, years even. But now I am giving you the secret sauce. Okay? By tomorrow or next week, you should trade like this. Use all these tools ready for you, man. This is free. Trading view is free with all these indicators. The fractal, the MACD, and this favorite retracement tool. Okay? If you don't know how to use the favorite retracement, I will teach you now and hope you will never forget this. From if in an uptrend, okay, you see breaking the structure there. Okay, now go to the lowest you can find, the lowest price in this price action. Okay, down if you want to go up, down going up. Okay, down going up, down going up to the highest higher high you can find at that time. There it is. There it is, my friend. Okay. Okay. Let's see the settings for my favorite tracement. Take a screenshot of this. Okay, you need 0.382. Okay, 0.618. Put a check mark in each. Huh? No problem with this. Forget about this. And then 1. All with check marks. And you can see because if you will just go now to TradingView, you will have all these kinds of colors here, red, green. It's so confusing. So I make it simple. Okay, my 0 is this color. What is this color? I don't know. Dark gray. Okay, that's why I'm giving this dark gray here. This line here of 0 is giving me this. Okay, this effect. Then the 0.382. Okay, it's just black. Just go for black. Black is beautiful. Okay. And 618, 0.618 is also black. And 1. Oh, sorry. This will be a dark. It depends on you. If you like colorful things, no problem. But I just want you to have these three figures here. 0, 0.382, 0.618, and 1. And the 0.5. You can put the 0.5 here, no problem. I can transfer the 0.5 here, no problem. It doesn't matter. Okay, just you need this 5. 1, 2, 3, 4, 5. And the 0.5, I want it in red because this will be the first stage for our golden zone. Okay, so I want it in red. That's it. That's your Fibonacci, and it will be as simple as this. Okay, favorite retracement, take the screenshot now. Okay, or take a photo on your mobile phone now. 5, 4, 3, 2, 1. That's it. I hope you get it now. Okay, and now you will have your favorite retracement. So going back to the strategy. Okay, the higher high. Now you mark it like that. Now it will go to your golden zone with your MACD confirming it's going in an uptrend, plus your fractal. A fractal pointing down means buy. Now you have all these three confluence, my friend. Buy, make some money. Make some money easily. Yeah, let's go. Buy here and it will fly. It will create a new higher highs. Leave it. Okay, and then move your stop loss here, just below this higher low. Put your stop loss in this price, 3361. Okay, it's going up there because this will be your new okay, this will be your new trending range here. Okay, again, put your Fibonacci. Okay, from this point. Okay, because now this is the low. Okay, before this was the low, higher low. Now this is the new higher low. That's it. From higher low to the new breakup structure. Okay. Now in this scenario, anything from near, it's near. That's why the 0.382 is also included in here, because sometimes it will not retrace deeply here. Okay. But as we will go with the presentation, now it's 7:30. We only have 30 minutes and have many things to tell you. But a little bit of everything have to go now. Okay, so it will go there, it will retrace, and then it will fly again. Anyway, I hope you get the idea now. Okay, golden zone plus your breakup structure. That's it. Okay. So it will be like that. Higher low, higher high, breaking the structure. Price went there, breaking the structure. Okay, break up structure, then a new higher high. And it will retrace, Price is not always perfect. Sometimes it will go a bit down, a bit up, a bit down, and another breakup structure. That is your bullish breakup structure. All right. Now, a bearish breakup structure, on the other hand, occurs when the price breaks below a prior support level, okay, indicating a downward trend. This is a cue for traders to consider selling or shorting positions as the seller dominates the market. Recognizing a bearish breakup structure early can help traders capitalize on the downward momentum while setting appropriate stop loss levels to manage risk effectively. There's your breakup structure, lower low forms. It will retrace. Now you have this line here. Now you have mark your lower low. Expect this to be broken. It broke there. Price went there, breaking, creating new lower lows, retraces, another breakup structure here, new lower low, retraces, and so on and so forth. I hope you get the idea. It's just the opposite of the bullish breakup structure. All right. So in the chart, you can see it here. Here, lower low, retraces there. Okay, creating new lower lows. This is I don't consider this. Okay, two candle combination is not clear for me. I have to see more candles. Now this is the full leg of this. Okay, a new lower low, create a new higher low. Okay, and this one. Okay, so and then it went down further there. I don't know where exactly now. Okay, that's it. That's the bearish breakup structure. I hope it's clear now. Okay, moving on. We have many more slides to go. So the strategy. When the MACD line crosses above the signal line, which is the MACD, this is the signal line, the blue line, following a bullish breakup, it confirms upward momentum. A cross below the signal line after a bearish breakup points to the opposite. They're just opposite. Opposite lang sila. To my fellow kabayans, I know I always speaking in English, but I can also speak Tagalog. Walang po, nagkatagalog din ako. Okay, but to make things easier, I'm reading in English, so I have to speak in English. Anyway, MACD can be particularly helpful in filtering out minor fluctuations, confirming that the breakup structure represents a genuine shift in market direction. So let's see what does this mean. Okay, when the MACD line crosses above, you see, is the blue above the signal line, a bullish breakout structure confirms upward momentum. Okay, let's see now. Okay. So it crosses, huh? It says there, it crosses above the line following a bullish breakup structure. Following a bullish breakup structure. What does that mean? Okay. Crosses between MACD crosses the signal line following a breakup structure. This is the breakup structure, my friends. This is it. This is it. This is what they're talking about. Now just buy. Okay, you are a breakout trader. You want, to break, to see the break. Then once the price went up there, it was this. What is this price? 3358. Okay, you want to enter at 3359. 0.00, put your buy order there. Buy order. That's it. When it hit your buy order, now you are in the trade and now you are capitalizing. You see? That's it. That's the strategy. That's what it means. So below the signal line, bearish break of structure points to downward momentum. Okay, let's check. Let's check that. Okay. MACD breaks. Okay, crosses the signal line. I hope you can see this. Okay, MACD crosses the signal line. That's it. And then there's a breakup structure here. Okay, this is the breakup structure here. You see? That's it. You can sell here. Okay, MACD says, MACD crosses the signal line, cross over this. And now there's a breakup structure here. This was the low. This was broken by these candles. You can sell here. MACD is going down. That's the strategy. That's the simple strategy here, my friend. Okay, that's it. That's how you will do this. Now you can trade anytime now with this strategy. Just go with the MACD, spot or snipe. We call it sniping. It's like you are like a sniper. Okay, snipe for the bullish breakup structure or the bearish breakup structure and trade like a pro. That's it. All right, moving on. Okay, we have another reminder for our giveaway. So just click at the end of the webinar and you can have the chance to win $1,000 real trading capital and trade in the ZOOE app. Okay, moving on now. Change of character. Now, this is something different, but it happens much less than the breakup structure, okay? So a change of character, I don't know how you pronounce it. Some traders pronounce this kochi, coach. Okay, let's just pronounce it coach, okay? Or chalk. Until now, I don't know. I just call it change of character. But when you see CHOCH, it means change of character. It indicates a change in the current market structure, suggesting that the current trend is likely to reverse or lose momentum. Now, you will have two types. A change of character indicates that the current market structure will shift from bearish. Okay, it was selling that time until you will see the change of character from bearish to bullish, leading to an increase in price. Now, price will now fly to the moon. A bearish change of character indicates that the current market structure will shift from bullish, okay, it was an uptrend, people were buying, leading to a decrease in price. Now, let's see how it looks like. Okay, this is how it looks like. It was on a bearish market. Prices were going down, lower low, lower high, okay, and a lower low. Okay, but you expect this to be respected, okay, to be in a downtrend. It should not break this, but it happened now. It's changed. Okay, it's not a breakup, so now it's a change of character. It broke the last lower high. Now price wants to go up, creating a new higher high. That's it. That's how simple it is. Okay, let's see in the chart how it looks like. Okay. Okay, let's see it sideways. Okay, here. Is it going high? Okay. Higher high, higher low, higher high. Okay. And then what happened here? Higher low. But you see, it's not breaking this, it's not creating new higher highs now. Okay. This is the problem. So where is the last higher low here? This low. Okay, this low is higher than this previous low. So this is the higher low. It broke here. Now this is the change of character. Okay? It is now the change of character. That's it. That's how you know. This is a trend line. Okay? If you see this, it's a trend line like that. Like that. There was a trend line at some point in time. Even here, you can do that. No problem. Trend line are subjective. You know, some people like to make it perfect. For me, no. As long as it's hitting there, it's no problem. Until you see, it started here early even. Okay, breaking this, but this was the low. Really, this is a proper low of this time, and it broke this. It broke the trend line, breaking the last higher low. That's it. That's your change of character. So mark it on your chart. Chalk. I don't know. Kochi. I don't know until now how to pronounce this. That's it. Okay. I hope it's clear, huh? Okay. Maybe some Q&A later on. A change in the current market structure suggesting that the current trend is likely to reverse or lose momentum, which is true. Okay. So that's it. See, that's the example I gave you. It was an uptrend, bearish change of character, chachi, kochi. That's it. That's your break of bearish change of character. For the bullish, it was going down, and this was now disrespected, forming a higher high. This is your kochi now. Okay, clear? I hope everything's clear. There's no question so far. Okay. See you in the Q&A. Now, fair value gaps. Have you ever heard of this? Anyone? FVG. Do you know about this? Any idea? Anyone? No one, huh? No one knows about this. Now you will know. You have to remember this FVG. A fair value gap is especially popular among action traders and occurs when there are inefficiencies or imbalances in the market. What are the inefficiencies? There's more sellers on that trend, more sellers or more buyers, depending on the trend we are looking at. Or when the buying and selling are not equal, fair value gaps can become a magnet for the price before continuing to the same direction. So it was going up, but FVGs are forming along the way, which I will show you. On a chart, a fair value gap appears in a triple candle pattern. There's always three candles involved in this price action. Okay, three green candles, three red candles. So when there is a large candle whose previous candle's high and subsequent candle's low do not fully overlap the large candle normally will be in the middle, the second candle. The space between these wicks is known as the fair value gap. Okay, want to see it? I will show you. There, that's the fair value gap. Three candles happens during closing. What do you mean? Closing of what? Okay, three candles. Same color candles, red and green. This is the fair value gap. You see the wick? This wick, okay, didn't overlap with this wick. You see? Their wicks are just there, forming a gap. This is the gap. This is the gap. The same with the bullish trend. Okay, the second candle. Okay, their wicks didn't touch. So there's some inefficiency here. There's inefficiency or imbalance here. This needs to be filled in the future. That's why it says here. It says here. Okay, fair value gaps. Fair value gaps can become a magnet for the price. Magnet for the price. So this magnet, it means price will come back here again. Okay? Before continuing to the same direction. So in this case, if it's a bearish, price will go there, tap this either by the wick or the body and going to the same direction. Now it will go back down again. Same with the bullish one. To went there forming this bullish fair value gap. You will see candles coming down here. Okay, filling this either partially or fully until they will have some orders here and buyers will just go inside this and start to buy here. They see the candle going there, buyers going there, and they will this go on the same direction. I will show you now in the chart. Let's spot if a fair value gap. There. From this, 1, 2, 3. This big candle here, okay? Okay, there's a gap here. You see this wick? Okay, you see this wick? It's not touching with this wick. And there's a gap in the middle. Let's make a box. Let's make a box out of that. That's your fair value gap. That's your FVG. As I told you, becomes a magnet for the price before continuing on the same direction. Let's see if it's true. Price went there forming the fair value gap. Price what? Went down there. Now the buyers are getting here. They are happy. They're having the party. They are having the party of their life. Now I want to capitalize. Yes, let's go. Buyers come in, pushing on the same direction. You see, this is your capitalization. You have to profit now. From this point, 333435 to 3446. That's 100 pips. It's not a joke. You can capitalize with 100 pips. This is $1,000 with your 0.10 lot. Okay? That's the meaning of this fair value gap. So this is one of the very powerful fundamentals. Okay? You can use every day. That's a bullish one. Let's find the bearish one. There. You see this candle? 1, 2, 3. Okay. Now this is a special case. Okay. Because this is a green candle. Okay. But there is still a gap. Okay. But the majority of the time you will see a same color candle. But this is a special case. Still a gap there. This wick didn't touch with this wick. You see what you are talking about. You see this one. Oh, this is also a fair value gap, a small one, but it's not substantial to price to go there. Okay? This is the gap. This. Okay? There's an imbalance, a big imbalance here. I don't know, for 3406 to 3394. That's a lot of pips to fill. Okay? Buyers were just going and the buyers were not able to fight this pressure. That's why it just went there, boom, like that. Okay? So price went there. Aha, fair value gap. Hello. Let's go. Let's make this fill this gap here. They are going. The buyers are going there, buying, filling all this price action there, which are the imbalance from 3406 to 3494, filling all these orders. They are now putting all these orders here until it now went to the same direction of this. This was selling. Now it was selling. You see, that's how simple the fair value gap works. Okay, so practice this and you will see all this every time, every day. Okay. That's it. Okay, fair value gap. This. There's a gap. There's a gap. You see? This wick didn't touch with this wick and forming this gap here. So this is a fair value gap. I told you it went down. Price went back there, capping this area, not fully filling this gap, but it went there. It's always a magnet for the price. Went there and start to sell again. You see? You can always see. You see, I missed this. Don't worry, my friend. Is there a fair value gap? Yes, sir. So go there, and then price will go back to this fair value gap, tapping in partially or fully, sometimes partially. But price still went there. Why the price went? It was going down. But there is an imbalance. Okay, now everything has to be filled. There it is. Okay, I hope you know now. Now you have some idea of what a fair value gap. Okay? All right, let's move on. Sorry, time is now in a premium. Sorry, I have to go sometimes very fast. Understanding fair value gap, okay, it's the imbalance in price due to inefficient movement, identified with three candle pattern, often revisited by price later, which I showed you. Smart money uses FVGs to enter or exit positions. That's it. Okay. So how to identify fair bags? Use a three candle pattern, impulse, gap, and then a return. Look for candles with no overlap in wicks or bodies. There's no overlapping of their bodies. You see here, let's zoom in. What are you talking about? You see, the body is there. It's not overlapping with this, and this body is not overlapping with that. And the wicks also, there's the gap. You see, there's the gap there. You see, this box here, wick to wick. Okay, you want it perfect? There's your gap. From this wick and this wick, that's the gap. Okay, that's it, my friend. And wait for the price to return to the gap before entering, which I showed you. You see, wait for that. Okay. It taps the fair value gap, sell. Go down now. You'll go down and you will be having lots of profit again. Okay, moving on. See, that's it. That's the gap. Okay, candle reject inconsequent encroachment. See, price went there, went to the gap, tapping this gap here, fair value gap, and price went back to its intended direction. So price revisits the imbalance zone and continues on the intended direction of the trend. Now, another reminder here, we have a $1,000 real trading account capital giveaway. So just stick to our webinar and you can have the chance to win this amazing giveaway to trade. Okay, moving on. Liquidity concepts. Liquidity means the ease in which a market can be traded without affecting its price. The market with lots of buyers and sellers at any given time is said to be highly liquid because you'd be able to find a counterparty to buy or sell it easily. So areas where stop orders are collected. So liquidity are areas where stop orders are collected. So there are equal highs and lows and trend line liquidity, which I will show you now. So areas where stop orders are collected. That's it. This is it. A liquidity grab, okay, is a tactic employed by larger traders, often institutional investors, to manipulate market temporarily. It involves pushing the price beyond a key level, okay, like a previous high or low, to trigger stop loss orders placed by other traders. So these stop loss orders create a surge of buy or sell orders, which the smart money then uses to their advantage to enter or exit positions at favorable price. Now, what you notice here, you see, they are just the same lows. Okay, it's not going it's not going anywhere. It's not breaking this line, this this sell side liquidity because okay, sorry, we call it the buy side liquidity because the intention was to buy after that. Okay, liquidity. Okay, they're all equal lows here until this candle sweep this. You see, if you are a buyer, okay, you started buying from this candle. I want to buy. Okay, where you put your stop loss? You put your stop loss below this price, right? A lot of stop loss will be here now. All your stop loss are here, and this institutional investors, big banks, big institutions, they manipulate this. Now they want to hit all your stop loss, so you will be out of the game. Bye bye. Now they sell more from this point, triggering all your stop losses, and you lost the trade. You were okay. You were having some profit here. I don't know. This could be a 1 hour candle, which is a lot of money. And then they manipulate. They started to sell until they sweep all your stop loss here, and then from then they have their buy trades here ready. They have their buy trades here. They were selling, but they know they will kill you because you are a small time trader. They have billions, millions of dollars sweeping all the stop loss, and they have their buy order here or buy limit. Okay, at that time, and then it will trigger their buys, and now price went flying to the moon, leaving you behind. So you have to be very smart where you will buy, because if you will see equal lows here, then that's the institutional investors or big banks are waiting for. You are there, liquidity. You will be the liquidity. Do not be the liquidity. Okay, so that's the liquidity grab. So liquidity zones. In trading, liquidity zones are areas on a price chart where a large number of buy and sell orders are concentrated, often around key support and resistance levels or previous highs and lows. These zones are important because they represent potential price reversals and can offer opportunities for traders to enter or exit the trades. So just like that, you can see here, okay, they have this I don't know, this box here or line. Okay, this is where majority of the buying and selling had occurred. This is acting now as their support and resistance. It was a support, they buy. Okay, then broken this one, it's now become the resistance. So when price one went there, it's becoming a resistance. Now it was selling, and then it broke again. And they are all bouncing from this. Okay, this is support and resistance levels. So that's why it's called key support, and often around key support reserves. That's why these liquidity zones are there almost every time you see in the chart. Okay, now liquidity zones. Buy side liquidity, okay, is the volume of pending buy orders by stocks when traders execute to a sell order. Mostly they want to protect it with the buy order, okay, in case price moves against them. So they use buy stop to protect their capital and hedge against loss. So anyone selling at the price level will have a buy stop, okay, placed above that price. These are now the buy stops, okay? So buy stops rest above highs. So the old high, maybe this is yesterday's high. Okay, so buy stops are there. Then that is why the old highs like week high, day high, equal highs are termed as buy side liquidity. And the market makers try to grab these highs to convert the pending orders into market orders, and then, okay, convert the pending orders into market order and then move the market against them. In this way, they make profit from retail traders, and this is termed as liquidity hunt. Okay, as you can notice here, okay, it stops there. Okay, it's hitting this line here, this high here. It's try to grab some liquidity, okay, until such time. And now this is now the higher than this, than the previous high. And now all the buy support are here now. Now they liquidate you, hunting you. They push the price very fast. Okay, you don't have time to You don't have time to react because your buy stops are here. A breakout trader means when price breaks this high, you intend to price to go to continue higher. No, that's why you are putting your buy stop here. You want to buy because you are expecting price to go high. But this liquidity is the opposite. They will hunt your buy stops. It will trigger, It will trigger your buy stop. You are profiting a bit here, maybe, I don't know, 10, $50, $100, and then they will push the price down, liquidate you. Now you lost all your money and you lost the trade. That's how a liquidity zone acts. So that's the example here. Okay, it's already 8 o'clock. I'm sorry, we have to go fast. So traders who want to enter on a momentum breakout, traders place buy stop orders above recent highs, expecting the price to keep going once that level is broken, which is this example. You're waiting here, you're putting your buy stop here, you want price to go up now, but the liquidity hunters are there. They will hunt you, they will trigger your buy stops, and you lose the money. That's it. What is a buy stop? A buy stop is an order to buy at a price above the current market price. Okay? Example, current price is 1900. The previous high was 1910. So a buy stop might be placed at 1912. Okay, it's always higher than the current price. So this means if price breaks above 912, then the traders, because a trader believes, then buy. Because a trader believes price will keep rising, just like in this example. Okay? 1900 and 1910. This was 1910. Now you put 1912. Maybe it will go up. No, but they just trigger your buy stop and you lose. That's it. Okay, trend and liquidity is also one of the market structure here. Okay, refers to the concept that trend, especially in trending markets, can become zones where smart money traders accumulate liquidity, buy or sell orders before a significant price move. Retail traders often place stop loss orders near trend lines, as you can see here, and these orders are targeted by smart money to trigger large market. So, if you were a trend line trader, you will plot your trend line. Okay, it hit the trend line, it's respect the trend, it didn't bypass, so I have to buy. Now you are buying there. Okay, you are profiting there. Yes, you are happy. Yes, happy go lucky. But this these institutional traders, okay, these big boys push the price down. Where do you put your stop loss? Just below this. Just below these points here, this price here, you put your stop loss here. Now they hit your stop loss. Now you've lost all your money. Okay? And now they push the price up again, going to the same direction. That's trend line liquidity, my friend. Don't be the liquidity. Always remember, there's always some smart guy, okay, ahead of you. So when you profited here, put your stop loss away from this trend line. You put your stop loss here. At least you have some profit. Okay, because now, okay, higher, as I told you, higher low, where is the last lower? Higher low is this. It broke there. So if you have your stop loss there, then you made some money at least, but not losing all that money. Huh? So that's another tip for you. Trailing stop loss. We call it trailing stop loss because as you profit, you are moving your stop loss near you, near your price, near the current price, which is here. You see, now you now become the liquidity. Okay, moving on. Okay, another reminder, the giveaway will be announced later on how you will win this fantastic $1,000 real trading capital. All right, moving on. Algoter. So Algoter is a quantitatively driven trading company focusing on market making and multi-asset trading. Its expertise spans various asset classes, including futures, options, stocks, commodities, forex, and cryptocurrencies. Algoter is a quantitative trading service company with over 10 years of experience in strategy development, focusing on proprietary trading. As you can see, the numbers speak itself, 60,000 clients every year, 150 plus available traders, 1,000, then 46 million plus revenue in 2020. and 265 plus staff members worldwide. So please, you can always go to Algoter's website and read more of this awesome company. All right, moving on. Okay, now we have to introduce this copy trading for you because you can have a lot of benefits with this. Okay, so excuse me. Uh, in Algoter, there is now a copy trading option where there's 12 plus years of quant mastery meets your success. So, for example, what is copy trading? Autopilot for your trades. Copy trading lets you automatically replicate the trades of expert traders or advanced traders in real time when they buy, sell. Your account does too without manual effort. So you can always start with $100 with this. So, okay, all right. Let's get real for a second. Okay, I think some of you have tried following trading signals before. Maybe not. So, what is copy trading? Copy trading just lets you automatically replicate the trades of expert traders in real time. So, when they buy or sell, your account does too without manual effort. So, yeah, we've been there, and that's exactly why we built something radically different here in Algoter. So first, our system delivers 90% historically accurate, hard back-tested data across 15 plus years of market cycles. Huh? That is very powerful. Every single signal gets the triple verified, one by our AI, okay, and two veteran analysts with hedge fund experience, and lastly, institutional grade backtesting. These three layers of protection for your capital. And here's what really matters, proven 79% win rate. That's where we consistently see 26 to 75% of returns. So you can start your journey with an institutional grade edge. Just just one click on ZOE app. Okay, you can have copy trading. So this signal is completely uh, uh, free with no monthly fees, no hidden cost. That's exactly what we're offering. But this is not the best part, because we will offer under 100% of win promise. See, in this trading project program insurance, okay, okay. Uh, in this trading protection insurance, if you end, okay, at a net loss, just for example, trading is trading. We're Algoter is going to reimburse qualifying losses every week. You don't want that. That's very nice. So keep 100% of any profit you make means that you have zero risk. No risk. You can sleep well in the night knowing your capital is safe. So originally it's $1,500, okay, to subscribe for this, but with only a minimum of 500, okay, you can begin now with yours truly, as offered with this copy trading option here only tonight. Okay, you can have this on a lesser amount and have this copy trading option anyway. So if you will see the rules here, okay, there's your return of investment, 21%. Okay, okay, you will have a total commission as you go higher with your profits here. So the sweetest spot is the $6,000 because you will have a 26.79% return of investment here. So we just everything here, okay, $500 total commission fee and everything. You can read all about this. So please take this opportunity. Uh, what if you don't want to make some money on the side just by copy trading? Do so. Don't lose this chance. Contact your Algoter manager, and you will be making money, printing money like a money machine. Okay. So you can always some gold signal exclusives here. Okay. And it's all protected by the insurance. So please contact your Algoter manager to subscribe on this copy trading. Okay. Hope everything's clear, and I hope you will really think about this what we are offering here, because compared to other uh, prop firms or brokers, you will never find such uh, good amount of return of investment. So there will be daily 2 to 5 signals, complete trading guidance, and up to 1,000 daily loss coverage insurance. So please, and also they will have a 24/7 trade support and compensation trade every 7 calendar days. Okay, at the $30 commission per lot. So just imagine $30 commission per lot. It's a lot, huh? So please uh, contact your Algoter managers now. Now, ZOOE, as we know, I always use ZOOE not to trade. It's available on Google Play and App Store. It's very user friendly. So please download this on your phones now and trade the way smart traders trade. So please don't miss out. Never lose this chance to make money on the side. Okay, moving on. And we reached the end of the slide for the lucky draw. And our coach Jade will now explain to you further. And we will have maybe some Q&A along the way before we finish this webinar. So Jade, please take it away.
Hello. Hello, everyone. Thank you for joining us today. Thank you, Mr. Salian, for sharing the overview on trading fundamental tonight. And we have the lucky draw after this session. How to enter, just download our ZOOE app and then contact your Algoter assistant for the invite code to open the account, and then send your ZOOE user ID to us. The deadline will be 9 p.m., which means you still have 45 minutes to register on our app, and then we will announce the winner at 9:15 tonight via the Telegram group. In case you don't have the link, I will send it through the chat room, and then you can come in. And then about, according to the copy trading and the trading protection insurance program, you can ask your Algoter manager for more details. There's a very great chance to access. Thank you, everyone, and happy Friday. Good night.
Okay, is there any questions you want to clarify, want to ask? Don't be shy. Ask anything under the sun. We are here to benefit from this webinar. So please ask anything you want now on the chat. Tanong lang kayo. Wag kayong mahiya. Kahit ano yan, sagutin namin as much as possible. So please, magtanong lang. Okay, there's a question here. Who runs the ZOE? Who runs the ZOE app? Algoter and ZOE are partners for this trading on ZOE. So I hope that answers the question. Okay, we see. Okay, so it's a global financial technology company under the ZOE Group, headquartered in United Kingdom. Okay, specializing in safety trading. ZOE offers a diverse range of financial products, including forex, precious metals. So that's it. But Algoter has been partnering with the ZOE for their trading platform as a trading platform, and can make money as a beginner trader or as an experienced trader, regardless. So please, I hope that answers your question. Anything else? Thank you on the information by Joseph J. Okay, you're welcome. Henry, you're welcome, Henry. Okay, I think you don't have any more questions regarding with our webinar, and I hope we have I was able to at least give you some bird's eye view about market structure basics, the type of breakup structures, bearish breakup structure, bullish breakup structure, the change of character, bullish change of character, a bearish change of character, fair value gaps, which are very nice and always occurring every time in the charts, and liquidity concepts in trading. So I hope I covered that and gave you some insights about this overview on trading fundamentals, which is very, very important as a trader, as a beginner, especially as a beginner. And the more you go deeper in the trading game, you will always need to understand all this to capitalize every day. So with that said, I hope I was able to again share a lot of information on trading, and hopefully next time we will have other more to discuss in the future. So with that said, thank you again for joining us, and until we meet again, friends, thank you and good night.